Hello this is Chapter 5, Accounting for Retail Businesses. This is financial accounting. Let me adjust the camera. Okay, so I'm all set. So the learning objectives for this chapter distinguish between the activities and financial statements of service and retail businesses, describe and illustrate the accounting for retail transaction, describe and illustrate the adjusting process of a retail business, describe and illustrate the financial statements and closing entries for a retail business. Objective 5, describe and illustrate the use of asset turnover ratio in evaluating a company's operating performance. And then application objectives, describe and illustrate the gross method of recording sales discounts. And then 2 is describe and illustrate the periodic system of accounting for retail transactions. So this is looking at retail businesses where you sell product. Nature of retail businesses. The activities of a service business differ from those of a retail business. These differences are reflected in the operating cycle of a service and retail business, as well as in their financial statements. So the operating cycle is a process in which a company spends cash, generates revenues, and receives cash from customers. The operating cycle of a service and retail business differs in that a retail business must purchase merchandise for sale to customers. So here's the cycle. So cash goes to purchases of merchandise, merchandise goes to sales goes to accounts receivables, collections. So this is the cycle of how money and retail businesses receive money or cash or accounts receivable on credit. So the time in days to complete an operating cycle differs significantly among retail businesses. For example, many grocery items such as milk have a short operating cycle and must be sold within their expiration dates of a week or two. In contrast, jewelry stores often carry expensive items that are often displayed months before being sold to customers. So at Nappy, up on the big Navajo's farm, so there are pumpkins and like watermelons that have to be sold quickly. However, corn and beans are stored in silos, so they're usually kept probably 6 to a year, depending on how much storage space is available. So that's just another example in the farming industry. So the financial statements, the difference between service and retail businesses is also reflected in their financial statements. So notice on the left here, there's no cost of goods. Well, on the right here, there's cost of goods. Then there's gross profit, and then there's operating income. So the main difference is the cost of goods. Your operating expenses are still there. We'll just deduct them a little bit further. Revenue activities of a service business involve providing services to customers. On the income statement for a service business, the revenues from services are reported as fees earned. The operating expenses incurred in providing the services are subtracted from the fees earned to arrive at operating income. On the other side, the revenue activities of a retail business involve buying and selling of merchandise. A retail business first purchases merchandise to sell to its customers. When this merchandise is sold, the revenue is reported as sales and its cost is recognized as an expense, so called cost of goods sold or cost of merchandise sold. The cost of goods sold is subtracted from sales to arrive at gross profit, which is the profit before deducting operating expenses. Then the operating expenses are subtracted from gross profit to arrive at operating income. Merchandise on hand or not sold at the end of an accounting period is called inventory or merchandise inventory. So inventory was reported as current assets on the balance sheet. And just to give you an idea, Nappy's cost of goods sold, I was talking about this with my daughter because we drove by Nappy on Saturday, and I told her that the cost of goods for Nappy is usually $70 to $80 million a year. So just to put things into perspective for the 72,000 acre farm that Navajo's owned. Merchandise transactions are recorded in the accounts using the rules of debit and credit. However, since merchandise transactions differ from those of a service business, Net Solutions adopted a new chart of accounts. So this is the example, Net Solutions. The accounts related to merchandising transactions are highlighted in blue. The chart of accounts now consists of 3-digit account numbers. The first digit indicates the major financial statement classification, 1 for assets, 2 for liabilities, etc. The second digit indicates the subclassification, e.g. 11 for current assets, 12 for non-current assets. The third digit identifies the specific account, example 110 for cash. And let's see, there's an example of what was just talked about. This accumulated depreciation, liabilities, all the way to dividends. Income statement accounts. Again, these are still income statement accounts. Subsidiary ledgers, a separate account for each customer and creditor could be added to the ledger. However, as the number of customers and creditors increase, the ledger will become larger and awkward to use. A large number of individual accounts with a common characteristic can be grouped together in a separate ledger called a subsidiary ledger. The primary ledger, which contains all of the balance sheet and income statement accounts, is then called the general ledger. Each subsidiary ledger is represented in the general ledger by a summarizing account called a controlling account. The sum of the balances of the accounts in the subsidiary ledger must equal the balances of the related controlling account. Common subsidiary ledgers are the account receivable subsidiary ledger, the accounts receivable subsidiary ledger or customer's ledger lists the individual customer accounts in alphabetical order. The controlling account in the general ledger is accounts receivable. So keep in mind, if you have a lot of customers, that's why you're going to have a list. You're going to list them in alphabetical order, and that's why it's called the accounts receivable subsidiary ledger. So however many people you have buying merchandise from you, that's how many you'll have. Accounts payable subsidiary ledger. The accounts payable subsidiary ledger or creditor's ledger lists individual creditor accounts in alphabetical order as well. So again, whenever you create an account payable or you owe people money for something that they did for you, let's say you bought, I don't know, a bunch of bearings for a wheel, well, those are that you'll have to pay a vendor that amount. So each of your vendors that you pay gets their own account payable account, and they are listed in alphabetical order. The controlling account in the general ledger is the accounts payable. Inventory subsidiary ledger. The inventory subsidiary ledger or inventory ledger lists individual inventory by item, barcode, or number. The controlling account in the general ledger is inventory. Most retail companies use computerized accounting systems that record similar transactions in a separate journal called special journals. These journals generate purchase, sales, and inventory reports. So we'll get into that here in just a bit. Purchase transactions, there are two systems for accounting for merchandise transactions. There's perpetual and periodic. In a periodic or a perpetual inventory system, each purchase and sale of merchandise is recorded in the inventory account and related subsidiary ledger. So in this manner, the amount of merchandise available for sale and the amount sold are continuously or perpetually updated in the inventory records. In a periodic system or inventory system, the inventory does not show the amount of merchandise available for sale and the amount sold. So instead, a listing of inventory on hand called a physical inventory is prepared at the end of the accounting period. This physical inventory is used to determine the cost of inventory on hand at the end of the period and calculate the cost of goods sold during the period. So under the perpetual system, cash purchases of merchandise are recorded as follows. So right here it says inventory increased, but we use cash, or cash is going to be credited or inventory debited. Purchase of inventory on account recorded as follows. So inventory went up, and so this indicates we created a payable to Thomas Corporation for our inventory for $9,250. The term of Terms of purchase on account are normally indicated on the invoice or bill that the seller sends to the buyer. So here's the invoice and our terms. Let's see, where are our terms? I'm not seeing our terms. Here are our terms. So 210 net 30. So 210 means a 2% discount if it's paid within 10 days. In means net 30. Otherwise, it has to be due within 30 days. That's what that means right there. And those are the terms they're talking about. The terms for when payments for merchandise are to be made are called the credit terms. If payment is required on delivery, the terms are cash or net sales. Otherwise, the buyer is allowed an amount of time known as the credit period in which to pay. The credit period usually begins with the date of the sale and shown on the invoice. Purchase discounts to encourage the buyer to pay before the end of the credit period. The seller may offer a discount. For example, a seller may offer a 2% discount if the buyer pays within 10 days of the invoice date. If the buyer does not take the discount, the total invoice amount is due within 30 days. The terms are expressed as 210 net or in 30 and are read as 2% discount if paid within 10 days, net amount due within 30 days. So I kind of explained that earlier. Credit terms, here's just an example of it. You can take a look at that in more detail in your book, but it's kind of the invoice date, and if it's paid within 10 days, you get a 2% discount. So, I mean, it's a pretty good deal considering 2% of $3,000 is probably what 2% on 1,000 is, or on 1,000 would be $20, $40, I think. No, is it 40? Yeah, 20, 40. So $60 on $3,000 account. Purchase discounts taken by the buyer for early payment of an invoice are called purchase discounts. Purchase discounts taken by a buyer reduce the cost of the merchandise purchased. Let's see, so assume that Net Solution places an order from Alpha Technologies on January 5th, terms of 210 net 30, in order to pay the invoice on January 15th, the last day of the counting period. Oh, so this kind of looked at what happened before, because I remember I just did the math on 2% discount on $3,000 is $60. All right, if an annual interest rate is 6% and a 360-day year is assumed, the interest on the loan is $2,940. For the remaining 20 days of the credit period is $9.80. Okay, so here's a purchase discount, $60, interest rate at 6%, $9.80. So total savings taken from the discount is $50.20. The terms of purchases on accounts are normal indicate on invoice or bill that the seller sends the buyer. So 10%, 360 out of 20 days equals 2% times 18, which is 36%. Since buyers normally take all purchase discounts, inventory is debited for the net purchase price under the perpetual inventory system. That is, the buyer debits inventory for the amount of the invoice less the discount. So here's what this looks like. So Net Solution would record Alpha Technology invoice and its payment as follows. So here's our inventory. It's going to account payable for $29.40. So account payable, so we paid within 10 days. Account payable $29.40, and comes out of our cash or debit. So this, we just actually paid our Alpha Technologies within the 10-day period. So down here at the bottom, if Net Solution did not pay within the discount period, inventory will be debited for the amount of the missed discount. So right here we'll see account payable $29.40, inventory $60, and cash $3,000. Okay. Now notice the dates. This is January 15th. This is February 4th. So we paid within 30 days, and that's 30 calendar days. Is it 30 calendars? Yeah, it's 30 calendar days, not 30 working days. Okay, so then we put that back into our inventory because that amount goes back in there. Purchase returns and allowances. A buyer may request an allowance for merchandise that is returned. Purchases return, or a price allowance. Purchases allowance for damaged or defective merchandise from a buyer's perspective, such returns and allowances are called purchase returns and allowances. In both cases, the buyer normally sends the seller a debit memorandum, often called debit memo, to identify the seller of reasons for the return or to request a price reduction. A debit memo also informs the seller of the amount the buyer proposes to debit to the account payable due to the seller and states the reasons for the return or the request for the price allowance. So here's what a debit memo might look like, and just goes through there the date at 90, so that must have been 10 items. Right over here it says 10 items, so that's how we get $900. And right here it says are being returned via parcels. Our order specifies, so it should indicate on there. The buyer may use the debit memo as the basis for recording the return or allowance or wait for approval from the seller. In either case, the buyer debits account payable and credits inventory. So here's what that would look like. That $900 we looked at earlier, and look at this. Our account payable went down 900, and our inventory also went down 900. Because don't forget, inventory is going to be a debit, so we're minusing 900, and our account payable, we're taking off 900 out of there as well. All that's happening is we're basically reversing the transaction for that amount. Before paying an invoice, a buyer may return inventory or be granted a price allowance for an invoice within a purchase discount. In this case, the amount of the return is recorded at its invoice amount less the discount. Assume the following data concerning a purchase of inventory by Net Solutions on May 2. Purchase 5,000 inventory on account from Delta Data Link terms, 2% discount paid within 10 days, otherwise net 30 or the remaining balance within 30 days. So here it is. Hang on one second. 5,000. So initially we recorded as 49 because we did pay it within the discount period, 2% discount. So inventory for 4,900. So we sent to account payable for 4,900. This says we return 1,000 of inventory purchased on May 2. So here's notice how we did have to take into account the 2% discount as well. So account payable is going to decrease. Our inventory is also going to come down 980. So a return portion of merchandise purchase. So whatever the reason was, we returned some of it. So then from there, we decided to pay we paid 2% less the return discount. So we paid our account payable for $39.20. So if you take this, subtract the $980, you should get $39.20, which is right here. It shows right here, and then our cash will be deducted for $39.20 as well. Again, we paid this within the 10 days. That's why we get the discount. So on August 10, I don't know how you say that, Knopfler Company purchased inventory on account from Freight Company for $11,500, terms 210 net 30. That's really common, by the way, 210 net 30. I've seen 210 net 15 as well. Knopfler returned inventory with an invoice amount of $2,500 on August 14 and received full credit. Journalized Knopfler's entries for the purchase, the return, the payment of the invoice on August 18. So that's actually going to be very similar to this right here. These series of entries right there. So here we go. Inventory, $11,270. And don't forget, we're taking the discount. As you can tell right here, the 11.5 times the discount. So it's a minus there. So that comes to $11,270 inventory. And we are going to credit accounts payable $11,270. So then we had a return and inventory. And don't forget, we still have to take into account the 2% discount. So $24.50. And that's 2%. If we'd have done it, would have not minus the discount, would have been for $25,000, but we're doing the discount, so it's $24,500. That's coming out of this account payable right here, and then our inventory for $24.50 as well. And then we paid it on August 18th within the 10-day period, so we get the discount, so 88. So this minus that will give us 88,200. So that's coming out of account payable, and we're paying cash for that, so 88.20 as well. So revenue from merchandise sale is usually recorded as sales. Sometimes a business may use the title sales of merchandise. So assume on March 3rd, Nesolution sells merchandise for $1,800. These cash sales are recorded as follows. So we receive cash for $1,800 and sales, and to record cash sales. And don't forget, this one goes directly to our, oh, not that one. Where did I go? Wrong direction. 1,800 went directly to our income, and this one went to our balance sheet. Using the perpetual inventory system, the cost of goods sold and the decrease in inventory are also recorded. In this way, the inventory account indicates the amount of inventory on hand not sold. So assume the cost of goods sold on March 3rd is $1,200. The entry to record the cost of goods sold and the decrease in the inventory is as follows. Cost of goods for $1,200, okay, inventory $1,200, okay. And don't forget, cost of goods sold is an expense. So this is going to the income statement and this is going to the balance sheet of inventory. And inventory, don't forget, is a current asset. Sales may be made to customers using a credit card such as MasterCard or Visa. Such sales are recorded as cash sales. This is because these sales are normally processed by a clearinghouse that contacts the bank and issued the card. The issuing bank then electronically transfers cash directly from the retailer's bank account. Thus, the retailer normally receives cash within a few days of making the credit card sale. If customers use MasterCards to pay for their purchase, the sales would be recorded as shown in March 3 entry on slide 41. That must be back. Any processing fees charged by the clearinghouse or issuing bank are periodically recorded as an expense. So don't forget, if you have a business account or a business credit card, and if you have a fee that's attached to your credit card, you can write off that as an expense, as it states right there. A lot of times when I do taxes for small business clients, they forget to write off the interest on their credit cards, but it has to be credit cards used for the business. This expense is normally reported on the income statement as an administrative expense. So here it is. Assuming that Solution paid credit card processing fees of $4,150 on March 31, these fees would be recorded as follows. Credit card expense $4,150, and that comes from cash. So our cash is decreasing, and that is going to expenses. Sales on account, net Solution merchandise sold on account for $18,000. The cost of goods sold was $10,080. So 18. So these transactions happen. These two transactions and journal entries happen simultaneously. So once you make the sale, this goes to account receivable because you did it on an account. So sales of $18,000, which goes to our income statement. That's a balance sheet. Our COGS, cost of goods sold, goes into our income statement as well as an expense, and then that also comes out of inventory. So don't forget, we purchased inventory, but now we're pulling in this particular amount out of inventory. Customer discount. A seller may grant customers a variety of discounts called customer discount as incentives to encourage customers to act in a way benefiting the seller. For example, a seller may offer customer discounts to encourage customers to purchase in volume or order early. So a lot of time people, whenever they see these big trucks leaving Nappy, they say that they pay less. Well, part of the reason why they pay less is because they pick up large bales, 1-ton bales of alfalfa or hay, and whenever they take it right off the field, they get a discount there because they're not paying a transportation fee. Because of, for example, if you purchase a small bale from Nappy at the Region 2 scales, there's a transportation fee from the field all the way over to the Region 2 scales. So there's a little bit more of a price. But the thing is, if you also buy in a large quantity and have a contract, then you pay less as well. All right. Sales discount encourages customers to pay their invoice. For example, seller may offer. This is a 210 at 30, which provides 2% sale discount, and the invoice is paid within 10 days. We already went through this. So here it is. Account receivable 17. So we took the 2% of the 18,000, 17,640, and our sales goes to 17,640. So account receivable is our balance sheet, and our sales goes to our income statement. The sale to digital technology recorded by Net Solutions at the most likely amount expected to be received, which is $17,640. This invoice amount of $18,000 less the sales discount is $360. This method of recording sales discount is called a net method. So the payment of digital technologies on March 19th is recorded as follows. Cash, so we're taking out, we're receiving cash of $17,640, and our account receivable account for our customer is going down for $17,640. So they paid their account within 10 days. Customer discount: if digital technology did not pay within the discount period, Net Solutions would receive $18,000 in sales would be credited for the amount of discount. The payment would be recorded as $18,000 right here, and then our account receivable would also go down for $17,640. This would go to sales. So keep in mind that's the adjustment. This is when they didn't pay within the discount period. So cash refunds and allowances: a buyer may receive merchandise that is defective, is damaged during shipment, or does not meet the buyer's expectations. If the customer has already paid for the merchandise, the seller may pay the buyer a cash refund. If the customer purchased the merchandise on account, the seller may grant a customer allowance that reduces the accounts receivable owed in the original selling price when this is done. We actually looked at customer allowances earlier as well. That was whenever we made adjustments. When this is all done, the seller sends the buyer a credit memorandum or credit memo indicating its intent to credit the customer's account receivable. Cash refunds and allowances. So here's an example. Customer refund payable, $900, cash $900. Okay, so we offered a refund. Customer refunds payable is a liability account for estimated refunds that will be paid to customers in the future. It is recorded at the end of the accounting period as part of the adjusting process. In some cases, a customer who is due a refund has an outstanding account receivable balance. Instead of paying a cash refund, the seller may grant the customer an allowance against the customer's account receivable. When this is done, they send a credit memo indicating the intent to credit the customer's accounts receivable. So assuming that instead of paying cash refund to Blake & Sons, Net Solutions granted Blake & Sons a $900 customer allowance. Net Solutions notifies and allowances by issuing the credit memo shown on the next slide. So here's the allowance for damaged merchandise on shipment for $900. So here we go. Customer refunds payable for $900. Account receivable goes down $900. Okay. Estimated inventory return inventory is a current asset account that is reported on the balance sheet after inventory. It represents an estimate of merchandise that will be returned by customers. It is recorded at the end of the accounting period as part of the adjusting process. So here's an example. So selling price for $3,000 and the merchandise original cost was $2,100. So customer refund of $3,000, cash of $3,000. So this is those are both inventory or balance sheets. Inventory $2,100, estimated return inventory $2,100. So those are done simultaneously. Journal entries to record customer refunds, allowances, and returns. Here are the examples. So take a look at those for just a bit and see what that looks like. They're just denoted with X's because those are indicating an amount. So this is checkup. These are transactions we're looking at. So account receivable $1,160, sales. So we sold some merchandise, and cost of goods. So we're doing this automatically. 8,000 COGS, inventory 8,000. So these are pulling off what we just sold. Customer refund, so we offered a refund, payable, and right here we're pulling this out of their account receivable account right there. Inventory of 2,000. So notice how we're pulling this as well. We're saying that, hey, hang on one second, that's not an inventory anymore. Estimated return inventory. And then at the bottom here, we paid cash. We received cash because now they paid their account receivable, Wall Company, for $88.20. Freight. Purchase and sales of merchandise often involve freight. The terms of a sale indicate when ownership, title, and control of the merchandise passes from the seller to the buyer. The point determines whether the buyer or the seller pays the freight costs. So FOB shipping point is free on board. The term means that the buyer pays the freight costs from the shipping point to the final destination. Okay, such costs are part of the buyer's total cost of purchasing inventory and are added to the cost of the inventory by debiting inventory. So here's what that would look like. So inventory for 1,200, account payable, let's see, 1,200, and then inventory 50, and then cash 50, and that's paid shipping costs on merchandise. So that's here, paid $50 on June 10th purchase from Magna Data. So freight, the ownership of the merchandise may pass the buyer when the buyer receives the merchandise. In this case, the term are said to be FOB, free on board destination. This term means that the seller pays the freight cost from the shipping point to the buyer's final destination. When the seller pays the delivery charge, the seller debits delivery expense or freight out. So NAPI, when they ship large amounts of alfalfa, the purchasing company or person pays FOB. So they pay for all of the shipping. I guess even if you buy alfalfa from NAPI, you're paying the shipping charges. Assume that Net Solutions sells merchandise as follows. June 15th sold merchandise on account, so that's to be account receivable for $700. Term FOB destination. The cost of goods is $480, and then pay freight of $40 on the sale. Okay, so record these. Here's a recording. So $700 goes into account receivable, and that's going to go to sales. Balance sheet, income statement. Cost of goods is balance sheet. Inventory of $480, so we're pulling $480 out of our inventory. Our cost of goods will go straight to our income statement. Our delivery expense will be income, and we're saying that this is how much was expense, and we paid cash on that. The seller may prepay the freight, even though the terms are FOB shipping point. The seller will then add the freight to the invoice. The buyer debits inventory for the total amount of the invoice, including the freight. Any discount terms would not apply to the prepaid freight. So here's an example. Sold merchandise to Planter Company on account 800, terms FOB shipping point. Freight is $45 and is added to the invoice, and COGS is $360. So here's this recording sales. Account receivable $800, sales $800. So balance sheet, income statement. Cost of goods, that's how much these cost of goods costed, was $360. We're pulling this, we're pulling this out of inventory, and then our account receivable was $45, and cash was paid for that. So freight terms, here's an example. FOB shipping point, title passes to buyer, seller, and then they're taking care of that. Here's the journal entry for that, and then here's FOB destination. So seller is paying the freight, and then the title passes whenever they receive it. Here are the recording inventory transactions. You can take a look at those in more detail. So each merchandising transaction affects a buyer and a seller. So here's some examples. Here's inventory transactions for seller and buyer. So if you go through those and look at those in a little bit more detail. And here's some more of those, the inventory examples as well. Sales tax, almost all states levy a tax on sales of merchandise. The liability for sales tax is incurred when the sale is made. At the time of a sale, a cash sale, the seller collects the sales tax. When a sale is made on account, the seller charges the tax to the buyer by debiting account receivable. The seller credits the sales account for the amount of the sale and credits the tax to sales tax payable. So here is an example. $100 on account, subject to 6% as follows. So $106 is charged to account receivable. The sales is $100, and the sales tax payable is $60. Don't forget, this goes into a payable because we owe this money to the state, local, or federal government. Here's another example. On a regular basis, the seller pays the taxing authority, so sales tax payable of $29, and then we pay them cash of $2,900. So this is maybe quarterly payments, or sometimes monthly, depending on how much sales you have. Trade discounts, okay. Many wholesalers publish or upload sales catalogs online. Wholesalers often offer special discounts, okay. So these are called trade discounts. So here's an example. Assume that an item has a list price of $1,000 and a 40% trade discount. The seller records a line. The sale of the item as $600, $100,000 less the trade discount, $400. Likewise, the buyer records the purchase as $600. Adjusting inventory for shrinkage, that means like theft, loss, things like that. Under the perpetual system, the inventory count is continually updated for purchase and sales transaction. As a result, the balance of inventory count is the amount of merchandise available for sale at that point in time. However, retailers normally experience some loss of inventory due to shoplifting, employee theft, or errors. Thus, the physical inventory on hand at the end of the period counting period is usually less than the balance of inventory. This difference is called inventory shrinkage or inventory shortage. Adjusting inventory for inventory shrinkage, account balance of inventory is $63,950, physical $62,150, so the difference is inventory shrinkage. And here's how we do that adjustment. Cost of goods, $1,800, and then inventory. Keep in mind, all we're doing is pulling out $1,800 of cost of goods, and we're also pulling out $1,800 of inventory. So after the preceding entry is recorded, the balance of the inventory agrees with the physical inventory on hand at the end of the period. So sellers are required to estimate returns and allowances at the end of an accounting period and prepare two adjusting entries. The first adjusting entry reduces the sale account and creates a customer refund liability account for the estimated refunds and allowances that will be granted to customers in the future. The second adjusting entry creates an estimated return inventory account for the cost of merchandise that is expected to be returned and reduces cost of goods sold. So here's an example. So here's our sales. Our cost of goods is $523,505. Inventory returns $300. Customer refund payable $800. Cost of merchandise $5,000, and then 1% estimate. So here's what we would do. That 1% is $7,154, and sales and customer refunds of $7,154. Estimate, and then our inventory estimated returns is $5,000, and then cost of goods is $5,000. So basically, we're pulling that out. So here's some examples again. Let's take a look at this. Oh, hang on one second. So actually, I just explained that in the previous one. After the adjusting entries are posted to the ledger and adjusting trial balance is prepared, the adjusting trial balance for net solution as of December 31, 2018 is shown on the next slide. So here all of the adjusting entries, and the nice thing is $923,435, balance is $923,435, and our debit and credit balances. So in the previous, we went through this and created an unadjusted trial balance and then the final balance. Okay. Financial statements. So although merchandising transactions affect the balance sheet and reporting inventory, they primarily affect the income statement. An income statement for a retail business is normally prepared using a multiple step or single step format. Sales, cost of goods, gross profit, operating income, other revenue, and expenses. This is a multiple step. Total amount of sales to customers for cash and on account is reported in this section. So the amount of cost of goods sold to customers is reported in this section. Cost of goods sold may also be reported as cost of merchandise sold or cost of sales. The excess of sales over cost of goods sold is gross profit. Operating income, sometimes called income from operations, is determined by subtracting operating expenses from gross profit. Operating expenses are normally classified as either selling expenses or administrative expenses. Selling expenses are incurred directly in selling of merchandise. Example, sales salaries, store supplies used, depreciation of store equipment, delivery expense, and then advertising. So these are definitely within a multiple step income statement. Administrative expenses, sometimes called general expenses, are incurred in the administration and general operations of business. Example, office salaries, depreciation of office equipment, and then office supplies used. Other income, income from interest, rent, gains resulting from sales of fixed assets, and then other expenses as well. Other income and other expenses are often offset against each other on the income statement. Here's a multiple step income statement. So notice all of those little tiny steps: selling, administrative, and then our other revenue and expenses. So in all honesty, NAPI's income statement looks very similar to that. Okay, let's see. So here's another example. You can go through this in more detail. I won't read it to you. Okay, single step income statement. So that's basically just one step. Notice all it did was all the expenses, and then here's your revenues: sales revenue, rent revenue, COGS, selling expense, administrative interest expense. They're all put on one line or one section. So here's the common stock or statement of stockholders' equity. Okay, so you can take a look at that in more detail. And all of that closes out to our balance sheet. And there's our balance sheet. And let's see, the closing process, the two closing entries for a retail business are as follows: debit each revenue account, debit credit expense account, credit retained earnings account for income. And we did this already in the previous chapter, and going through and closing those accounts into the income statement. Okay. So the closing process, here it is. These are the debits, and these are the crediting of these accounts. Keep in mind, on the previously, these are balances that we have, and these are debit balances, and these are credit balances. But when we close them out, that's where we're closing these accounts out. And same with our retained earnings and dividends. After the closing entries are posted to the accounts, a post-closing trial balance is prepared. Okay. And here's the post-closing trial balance. So those are all of our debits. Here's all of our credits, and they balance at the bottom. Average turnover rate, sales divided by average total sales. Okay. Sales divided by average total assets, not sales. So here's an example. Let's see, asset turnover ratio is 1.6 for year 2. Year 2 is 1.6. Year 1 is 2.75. So there's where it's calculated. Gross method: sales invoice with credit terms and grant a discount for early payment. The customer pays within the discount period, cash debited, and amount received. The discount is recorded as a debit to sales, and account receivable is credited for the invoice amount. So here's what this would look like. And there's two entries that happen simultaneously. And this is with the gross method. Okay, and then cash, and then here's our sales, and then account receivable. So we got money. That actually went to sales because they didn't pay within the discount period. And then here it is. We received cash, and then $18,000. Since GAAP requires that revenue sales be recorded in the amount most likely to be received, the gross method requires an adjusting entry at the beginning of the accounting period. The adjusting entry reduces sales for an estimated sales discount related to current period sales that are expected to be taken in the next period. So here's what that looks like. Sales, account receivable, allowance for $100, and then estimated returns $1,700. And here's the sales, $1,700, and allowance for sales discount for $1,700. All right, here's an allowance for sales is a contra asset account, similar to contra asset accumulated depreciation. Okay, so here's what it looks like. So this is, you're anticipating that you're going to have $1,800 of allowances. So 92 minus 18, so then net account receivable will be $91,080. Subsequent period, customers with outstanding accounts receivable balance on December 31 will pay. Okay, And here's what that looks like. Cash received of $19.60, allowance for sale discount $40, and then account receivable $2,000 decreases in J. Smith's account. So here it is, $2,000, and cash increase, account receivable J. Smith decreased by $2,000. Comparison with the net method. So here are comparisons. Here's the gross and net. So look at the differences there. Our cost of goods and inventory doesn't change, it's just the way we do it up here. Cash here, and then notice how this is not here. 360 sales isn't added to it. Okay, and then down here, it's almost flipped right here. So those two are flipped. Adjusting entries 1700. There's no adjusting entry for the net method. Okay. Periodic inventory system. It's a manual perpetual inventory system, is time consuming and costly to maintain. In this case, the periodic inventory system may be used. Under the periodic inventory system, purchase are normally recorded at their invoice amount as a debit to purchase. Okay. And let's see. So here's a chart of accounts under the periodic. Very similar, just 100 though. Okay. And then here the periodic under office equipment all the way down to retained earnings, dividends, income statement accounts, and then depreciation all the way down to, these are all expenses, and then more expenses. Okay, recording merchandise transaction under periodic inventory system. So using periodic inventory system, purchase of inventory are not recorded in the inventory accounts. Instead, purchase account, purchase discounts, purchase returns, and allowances are used. In addition, the sales of merchandise are not recorded in the inventory. Thus, there are no detailed record of the amount on hand. At the end of the period, physical count inventory is taken. Physical count is used to determine the cost of goods sold. Purchase of inventory recorded in a purchases account rather than inventory account. Purchase is debited for the invoice amount of a purchase. Okay, so purchase discount normally recorded in a separate purchase discounts account. The balance of the purchase discounts account is reported as a deduction from purchases for the period. Thus, purchase discounts is a contra or offsetting account to purchase. Okay, a separate purchase returns allowance account is used. Purchase returns allowance are reported as a deduction from purchase. Thus, purchase returns and allowance are a contra asset as well. Under the inventory system, freight paid when purchasing merchandise, heavy shipping point is debited to freight in, transportation in, or in a similar account. So here's what this look like. Purchases, debit, effect increases. Purchase discount, credit, decreases. Purchase returns, credit, decreases. Freight in, debit, and it increases. So here's an example of using the periodic inventory system, and it'll go through and list what happens, and the transactions are right here as well. And this is the same one that's in your book. Adjusting process, adjusting process is the same under the periodic and perpetual system. The ending inventory is determined by physical count or under both systems. Okay, perpetual system, the ending inventory physical count is compared to the balance of inventory. So the difference of the amount of inventory shrinkage. Inventory shrinkage is then recorded as a debit to cost of goods sold and credit to inventory. Under the periodic inventory, the inventory account is not kept up to date for purchase and sales. As a result, inventory shrinkage cannot be directly determined. Instead, any inventory shrinkage is included indirectly in the computation of the cost of goods sold. Okay, financial statements are similar under each system. When multiple step format of income statement is used, the cost of goods may be reported. So here's an example. Periodic. And closing entries differ with periodic system. There are no cost of goods sold to account. Instead of purchase discounts, and those transactions are closed. In addition, inventory count is adjusted to end of period physical inventory count during the closing process. The estimated returns inventory count is also adjusted for the estimated returns from the current sales period. So 2 closing entries on the periodic inventory system are as follows. Entry 1 include the following elements: debit inventory, debit estimated returns, and then debit each revenue account. Okay. Credit inventory for its balances, beginning of the period. Credit each expense account. Credit the retained earnings, debit the retained earnings account, and credit the dividends account for its balances. So here are the closing entries of the periodic system, and these are the same ones as in your book right there. And that'll be the end of this presentation. If you have any questions, so I did put some homework up, and I'll try to take some videos of that homework as well. Thank you. I hope this helps out. Make sure you get your homework in Monday nights by midnight. Same with your discussion posts.